Hello, hello. Welcome back. Fresh news right out of the oven from Take-Two Interactive, a very, very well-known gaming company, which bought Zynga, another well-known gaming company that made Farmville. And they bought it for $11 billion in an acquisition that we're going to be examining in this video, and we're going to take a look at the financials of Zynga and see whether it makes sense that Take-Two bought them and whether that's a potentially sound position. And also, you will notice here that pre-market, because the move has been known just now, so the markets haven't even opened yet. They will be opening in about an hour. And Zynga is up almost 50% because of that move, which you would kind of expect it with this acquisition, especially for a beaten down stock like Zynga is. And we can examine the stock right now and check that Zynga has had some good growth in some previous years and then stalled for a while. I remember seeing it at around $2 or $3 and I was thinking about buying it actually back then. I didn't, unfortunately, but it went up to 12 here and then down to 6. And we do want to examine what's happening with the financials of the company and why Take-Two decided to buy the company. So let's take a look at the market cap, which is at $6 billion, and with the rest of the market being that high in terms of market cap, this almost looks like a small company. I mean, it's not, obviously, but $6 billion, I can stomach that, even if the company is not doing great financially, but we'll examine that. So let's take a look at the outstanding shares. It's important to check whether investors are getting diluted, and they are. They're getting massively diluted. That's like almost, wow, it's like almost double the stock amount that they printed, that they actually made available to new investors. It's like what, 500 million shares here. So that's a lot. So Zynga has been massively diluting investors. That's not great to see. That's not a good sign. But at least let me check it again. Is it actually steadying? It's actually going higher on here. Now it has been a little bit steady here, but that's like a year. So okay, yeah, I don't like to see that. Now Zynga has lost 40% the last year, which is a lot, obviously. As you can see, yeah, it went from like 12 to 6, and this is probably why Take-Two Interactive actually thought about the acquisition and decided to eventually buy them. But let's take a look at the financials of the company, see what made Take-Two buy the company. Now, I like the growth here. So the growth, the year-over-year growth in the last 3 years seems to be accelerating. So it looks like the company is doing better and better than the previous years. And regardless of that, they have been losing, some of their stock price value, which is a little bit weird to see based on the year-over-year growth here of gross profit as well. So that's also great to see. And let's take a look at the net income here. Now, yeah, that's not great here. As you can see, the company seems to be losing some money here instead of making, even though they are enjoying some growth. And I'm assuming this has to do with operations. Yeah, this is growing operating expenses, actually administrative expenses, and yeah, there's some pretty steep expenses here, like $1 billion here, and this is why they are losing money actually at the bottom line instead of actually making money. Okay, so that's something interesting that would require some taking care of from the company. Let's take a look at the balance sheet, see if the company is able to hoard some assets here. Yeah, the total assets of the company have been growing, and the total equity of the company are also growing, which is at the end the most important thing, I guess, in terms of the balance sheet. And let's take a look at the cash flow, see how cash is flowing within the company and how they're making their balance sheet really. Now, the cash from operations here is positive, which is great to see, and seems to be increasing apart from 2020, which was better than 2021, I guess. And regardless, I mean, compared to 2017 and 2018, for instance, and even 2019, it's still higher. So that's nice to see. And companies investing a little bit as well with some acquisitions here that they made themselves and investing in market securities. companies do like to invest a lot in market securities these days. I see it in many of those, and they don't seem to be spending too much in their own investing within the company, but rather investing in a lot of securities. I guess I guess they think the market is going up and up. So the total debt here that has been issued, you can see it's relatively high here, and 2020 and 21 and 19 was relatively high, and so for this reason you would expect these values to be positive here because the company is adding some debts or some obligations really, and a little bit of issuance of common stock here, but some repurchase as well. We kind of saw it before in the outstanding shares department. And yeah, the company seems to be issuing some debt here, but this kind of causes the difference, I suppose, um, in their financing years, basically financing expenses over the years. So let's take a look at the free cash flow here. So eventually, at the end of the day, this is what you kind of see being grown year over year, and over here you will see that in the last couple of years, this year wasn't the best for them when you compare it to 2020, and this may have been part of the reason why the company's stock has fallen. But the thing is, it may have fallen a little bit too much, because if you even exclude these 3 years before, which were not bad at all, and you just take those two, the average is like $350 million for free cash flow a year. And if you use a calculator, and you will see that I have already done that, and do 350, which is the average, and give it a multiple of let's say 20, is 7 billion. And the same amount, 350 million, give it a multiple of 30, which is more lucrative for a tech company, you get 10 billion, sorry. And here you will notice that the market cap is 6.72 billion. So for a multiple of 20, the company right now is undervalued. Now that's a multiple of 20 for a company that you don't. I mean, it's not like Facebook or Google, but still, I mean, it's reasonable for a tech company that's showing this kind of growth. And the thing is, after the markets open today, this is gonna change significantly because the company is adding 50% on its stock price, and that will actually add a lot to its market cap. It's gonna be near this value, and we'll give it a multiple of 30, and will likely increase its PE as well. So you would potentially want to get it before that happened, but the thing is, you can actually see why it's likely an interesting investment from Take-Two's perspective, from Take-Two Interactive's perspective. So I would understand it. I mean, it doesn't look weird to me. And the total debt of the company is a little bit of debt, but it's not too much of debt. And the Altman Z-score seems to be leaving the slightly dangerous territory of 1.46 here. Anything closer to 3 is best, and more is even better. But the total debt to equity, I mean, is not something to be concerned of at 50%. I wouldn't be concerned. I'd like it to be like near 30 if possible, but still, I mean, that wouldn't concern me too much. So, yeah, I mean, as I see this and examine the financials here, it looks to me like Take-Two's decision to buy Zynga is called for, and looks very, very interesting based on the fact that Zynga has lost a lot of its stock value, but it's still making quite a lot of money, and its cash flow is not negligible. And so I would love to get a little bit of Zynga before that happened here. I would see myself potentially getting a little bit of Zynga, but here it's gonna be a little bit of a tougher valuation for an investor to stomach here and enter. You can still do it, but and also there's gonna be some hype. So maybe you can harvest a little bit of that hype, because when acquisitions of that sort happen, it wouldn't be weird to see that the company stock price would go like 12 or 13 at some point. I wouldn't doubt that. But 12 or 13 is not called for when you are looking at the financials. That said, because of the acquisition, and because of the market sentiment, you could very, very well see that happen, and very, very soon also. So as a trading play, as a play for traders, I think that's great. For investors, I'd love to get it earlier. But if you can stomach like a 30 multiple, maybe you can enter and ride the wave, see how that goes, keep it for a little longer. I wouldn't hate that move. I think there are potentially better companies at this kind of valuation that's gonna open the market with today. But again, I don't think it's a terrible investment. No, no, not nowhere near that. I think it's an interesting investment for sure to enter even at $9. All right. So thank you for watching. Hopefully that was enjoyable and useful for you. If you did enjoy this video, you can leave it a like, because that helps a lot the channel grow, and subscribe. And in the meantime, you can also take a look at this video that I make about Alibaba and Charlie Munger, who seems to be loving it and bought double of what he already had. See you soon. Bye bye.